Hello everyone, welcome to today's US Open live webinar. It is Thursday, April the 6th, 13:20 GMT, 10 minutes before Wall Street opens as usual. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. Since our last sessions, markets have focused on some poor US data points that have caused renewed concerns over an economic slowdown, over the prospects of an economic slowdown, and have also weighed on sentiment. While on the monetary policy front, the Reserve Bank of New Zealand surprised markets on Wednesday with another 50 basis points rate increase. Before we get into all of that, however, as always, please read carefully through the risk warning and the disclaimers, and then we will get started. Okay, let's get to the ball rolling, and let's start with the Kiwi. Since on Wednesday, the Kiwi, the New Zealand dollar versus the US dollar spiked on Wednesday after the Reserve Bank of New Zealand raised rates by another 50 basis points against market expectations for a smaller move of 0.25%. And you can see this spike over here, which came right after another surge due to the higher oil prices from the surprise move by OPEC countries to slash production, which we already talked on Tuesday. Now, this move wasn't only bigger than what markets expected, but it was also in stark contrast with what the Australian counterpart had done just a day ahead, when it decided to hold rates steady. However, forward guidance officials did not offer explicit forward guidance, but the February projections point to a 0.25 percentage hike more, because the projected terminal rate of 5.5%. So that is probably our guide here for now. Now, despite the initial spike, the Kiwi quickly raised most of the gains as broader sentiment soured, and loses more than 1% today. This creates risks for further decline towards this region here, 0.619, and you can see that it also tests the 200 period exponential moving average. On the other hand, it may be too early to talk about a further slump towards 0.6464. However, as long as NZD USD manages to defend the 200 period EMA, bulls will be in control, and they may get another chance to push towards 0.6464. Just to correct myself earlier, we said that currently the pair is vulnerable to 0.619, but it may be too early to talk for a further slump to 0.6059, just correcting what I said earlier. And back to the upside scenario, if it manages to defend the 200-period EMA, which it tests right now, then it could get a chance to push further higher towards 0.6464, but does not inspire confidence at this stage for taking this level out and moving even higher. Of course, we expect some key data points tomorrow from the United States that could affect the trajectory, but as things stand now, the poor sentiment, the broader poor sentiment, weighs significantly on the pair. Now let's go to Euro USD. Once again, there's not much to add from what we have already said over the previous weeks, and especially after the policy decisions by both the ECB and the Fed. The outlook remains pretty much the same. The common currency stays in the driver's seat and on track to test 1.1065 and set new 2023 highs, but we're cautious at this stage for more. We can see that progress is low, and the higher highs that the pair posted, we can see here that the relevant strength index at the bottom of the chart did not actually follow. Now this divergence could point to downward pressure, and we could see a test of the 200-period EMA at around 1.076, 0.77, but a strong catalyst would be required for daily close below it and for the critical 1.055, 1.0461 region to be tested. Once again, there are data incoming tomorrow that could, of course, impact the trajectory. And as we're just a few minutes before the US Open, let's turn our focus on Wall Street and on the SP 500. So the broader US index made a strong start to the week, looking past the PEC plus production cuts that we have already talked about. But over the last couple of days, we saw poor US jobs data that sent it lower on Tuesday. Jobs opening in February dropped below the 10 million mark for the first time in nearly 2 years, whereas on Wednesday, ADP's data showed that the number of employed people in the private sector in March increased by just 140,000 people, a far cry from the last month's 261K addition. Today's jobless claims were a bit inconclusive, but they were definitely higher than what expected. This shows that the tightening policy by the Fed, the recent banking crisis, and all those factors are starting to weigh on the economy. But of course, now the big report will be the employment report of Friday, the NFPs. So this poor sentiment has weighed on the index, posted to a two-day decline, and this now makes it vulnerable to the critical confluence of supports found around 4.030, 3.997 region. Here, this includes the 200-period EMA, the daily Chimoku cloud, and the 38.2% Fibonacci of the March low April high advance. However, the downside appears well protected, and a strong catalyst will be required for those levels to reach. On the other hand, the US Fed has adopted a more conservative stance after the SVB failure and projects just one more hike ahead before pausing. Markets are even more dovish and expect rate cuts. Right now, CME's Fed Watch tool assigns the highest probability to rates falling to 4.25% by the end of the year from 5% currently. Of course, this is supportive for SPX 500, which finds support today. You can see here that it tries to contain the today fall, still in negative territory though. But above the 200 period DMA, it has the ability, momentum is on the upside and has the ability to push for new 2023 highs here at 4,196. Of course, we have said how there is high uncertainty, and we struggle to talk about moves much higher than that at this stage. Now, that's pretty much from a technical standpoint. So what's ahead is that on Friday, tomorrow, we expect the March employment report from the United States. It's an interesting backdrop. It's against an interesting backdrop since we talked about this bad data, weak data, jobs data that we had over the last couple of days. Now, the last report showed that 311K jobs were added and unemployment had risen to 3.6. However, this was still a strong report, and the labor market is still tight. Another strong report will put pressure to the Fed to become more aggressive, while weak data will allow it to remain on the recently adopted conservative path and stance. Now, other than that, many markets around the world will be closed on Friday and on Monday. Wall Street will be closed just on Friday. Things will quickly heat up though next week, as we also have the earnings season getting underway. The banking sector will be in focus. Typically, one of the first companies to report is JP Morgan, and other, of course, JP Morgan is also one of the companies we will be focusing on over the next during the current quarter, and you can find more on which companies will be on my radar during the second quarter on your respective FXCM Insights website. So that's it for me. Thank you for joining.